Good afternoon. I'm asking now also to the speaker if they can come on the screen. But let me, in the meantime, spend a few minutes to introduce the seminar. So, good afternoon and welcome to you all to today's online debate organized by the Florence School of Banking and Finance on the topic, the European banking sector preparing for consolidation. My name is Elena Carletti. I'm a professor of finance at Bocconi University, but I'm also a non-executive director at UniCredit, and I am very happy to chair the debate today. Before introducing the speakers and the topic, let me just spend a very few minutes to explain the context within which the seminar takes place. As you may know, the seminar is part of a new initiative that the Florence School of Banking and Finance has started recently, actually last December. This initiative is called the Bank Board Academy, and it has the objective of stimulating and enhancing the interaction of independent board members with the supervisor and regulators and among themselves. And the final objective of the initiative is really to help the non-executive directors in playing their role in the most valuable adding way. This initiative is built around the two pillars. We have a seminar series of which the seminar is today's part, that is entitled Challenges for Bank Board Members. And then we will start in June with the proper training, and we will have the first training in June, in the early June, on the topic better checks and control of risk, and then later on in October on topics that are more related to the fitter and proper guide of the supervisors and the governance of the banks more generally. So for more information, you can find more information on our webpage, and you are welcome to follow this initiative. And let me just remind you, for those of you interested in participating in our training course in June, that the deadline for registration is May 15. Having said that, let me now introduce our speakers today, and let me introduce them in the order in which they will start having the microphone. So we have Dominique Laboureix, who is the Secretary General of the French Prudential Supervisory Autority. We then have Luigi Vecchi, who is a Chairman EMEA Banking, Capital Markets and Advisory at the Citi Bank, but with a long past in topics related to merger and acquisition, therefore to consolidation, because he was the co-head of global investment banking at Credit Suisse and the managing director at Goldman Sachs and Kleinwort Benson. And the last but not least, Andreas Dombret, welcome back to our activities, from Columbia University, but also global senior advisor to many companies, including Oliver Wyman, Sumitomo Bank, and Banco Santander, and with a career also as a supervisor and the regulators, given that he was he's a former member of the board of the Deutsche Bundesbank. So thank you to all of you for being with us today. We really appreciate having the possibility to discuss this topic with you. So the topic of today, European banking sector preparing for consolidation, is certainly of great interest. There is not a day when we open the newspaper and we don't find an article talking about potential combination among banks in Europe, in different countries, in different contexts. Why such a great interest, or why so many speculation, is probably because the European banking sector is a little bit of a crossroad now, with the problems that now they are dragging on for a while of low profitability, low interest rate, high cost-to-income ratios, maybe a new surge in NPL due in particular to the COVID crisis. So in this context, more and more professionals of the sector and maybe also investors start seeing consolidation as a way out to this impasse that somehow is affecting the banking sector. Now, based on this, we would like to start the seminar by asking the question, okay, but what is really consolidation? Because as we know, consolidation has many different connotations, and we can think of many different combinations among different banks and type of banks. So I would like to start the seminar by asking each speaker to talk about what is consolidation, how they see it, and then we will proceed with the questions and so on. Let me remind you, each of you has no more than 5 minutes. And let me also remind instead the attendees of the seminar that we would really very much like to engage in a discussion. So feel free to pose your question in the chat, in the Q&A, sorry, not in the chat box, in the Q&A box. I also have collected already lots of questions from the registered participant, but feel free to add more if you want. And also let me say, given that the context of the seminar is the Bank Board Academy, let's try to really steer the discussion towards what is important to a non-executive director sitting in the board. So how should they think about consolidation? When should they consider engaging their bank in consolidation? What are the risks or the advantages of doing it? And with this, let me give the floor first to Dominique, then to Luigi, and then to Andreas. Dominique, please.
Thank you very much, Elena, and thank you for inviting me to participate in this seminar. And I must say that this seminar is really point in time. As you said, we can read in a number of newspapers that potential operations could occur. And the key question for us is why now? And a part of the answer is coming from the current crisis. The current crisis creates certainly a favorable context for banking consolidation because it creates opportunities by exacerbating the need for increasing economies of scale and by putting pressure on banks' valuations under stress. So that's true that the conditions for more consolidations are now on the table, perhaps more than before. And this is certainly why we see all these projects occurring now. But if we look at what consolidation is and what consolidation can bring, I would, let's say, underline two elements which can show why consolidation can bring value to some extent. The first one is about a way of solving some structural and long-standing issues faced by the EU banking sector. I have in mind three of them. The first one is, you mentioned it already, Elena, reducing overcapacity and fragmentation of markets. Globally speaking, this is certainly one key issue to solve. The second one is a way of helping banks face profitability challenges, because consolidation can provide for cost reductions, economies of scale, but also stronger market positions and adjusted or revised business models. So this is positive to some extent. And the third element, which can be positive for these long-standing issues, is, and you mentioned it, the problem of cleaning the balance sheets overloaded with NPLs. And to some extent, consolidation could be a way, not the only one, could be a way for solving, at a minimum, partly this issue. On the second hand, consolidation can also bring more resilience. And I would like to insist here on the diversification effect, which is extremely positive. Diversification by geographies, by business lines, by products, by customer bases, whatever you want, but indeed by putting together two previous competitors, we can bring value also from that angle, not value in terms of resilience. And the second element about more resilient banking sector is indeed by giving a more powerful institutional capacity, we can certainly expect more adjustment and more investments to face the new challenges. And I have in mind, in particular, new technologies, digitalization, which needs enormous IT investments, and also new competitors coming from non-regulated side. And I have in mind, obviously, the new technological giants across the globe. A dimension which should be at the core of our discussion about consolidation is the scope of consolidation. And I would like to insist here on three levels of consolidation. The first one is the domestic level. And when we speak about consolidation, some participants have in mind that the banking systems in Europe, throughout Europe, can be highly fragmented or can be highly concentrated already. And this dimension should be taken on board when we discuss the future of consolidation in Europe. But within a national country is not enough, because we are Europeans, and there's a second dimension, which is the European level. And here, indeed, we can see that the level of consolidation in the European area worldwide, compared to the US one, for instance, is much less concentrated. The 5 biggest banks in Europe represent more or less 20 to 25% of the European market, while the 5 biggest US banks represent more than 40% of the US market. So the degree of consolidation is not comparable in Europe compared to the US. And if we consider that Europe could be as large as the US, there is a question mark here. We have, to some extent, favorable conditions for that. We have a single rule book. We have an economic integration. We have, within Europe, a banking union, in particular with the SSM from the supervisory perspective. And so we have certainly good conditions for more cross-border consolidation within Europe. The third level I would like to mention is the international one. It's not enough to speak about European champions. We need to have European champions compared to other competitors worldwide. And here, we need to provide for an answer to our corporate, EU corporate, to give them all the products and all the answers they need to be active worldwide with European banks. And from that perspective, this international level could be also looked at for this seminar. From the supervisory perspective, let me finish with 2 elements here. The first one is, globally speaking, obviously, we are neutral. We are not in favor or against. We are not deciding on each and every decision taken by a board to merge or to swallow a competitor. It's not for us to decide, but we take the project as it is. And what matters for us is the sustainability of such a project. And the supervisor is in charge of, let's say, looking forward and preparing the future of the new entity, be it a merger, be it an acquisition, the new group in the case of an acquisition. So what matters for us is to see and to check if the new group is able in the future to respect all the prudential requirements. We were said in the past that we were unclear in the way to address this question, and that's why the ECB in its supervisory function decided to publish in last January, a final paper which gives light on how to address consolidation from a supervisory perspective, with 3 key items. We can come back later on. The first one on the treatment of the Pillar 2 requirement. It's not true that we ask a higher Pillar 2 each time there is a consolidation process. That's not true. We start from the Pillar 2s, the existing Pillar 2s, and we look at the consequences. The second element is the treatment of goodwill, badwill. And if there's a badwill, we can consider that it is usable for helping building the new group. And finally, the use of internal models for computing risk-weighted assets. And here again, we provided for a clear answer. We accept a transition period in case of a consolidation process. So with this, I think the supervisors gave a clear direction of travel. That's to say, neutrality, but the need for sustainability. And with that, we really hope that more consolidation will occur in the coming month and years. I will stop here, Elena. Thank you very much.
Thank you, Dominique. Thank you. This was an excellent start of the debate. Let me just come back. You touch upon many issues, but let me just come back on one issue that has been highlighted already in the chat, in the Q&A box. We talk consolidation usually is associated with deficiency of scales. Now, there is part of it, and I ask you because, of course, it comes from the regulatory side, which instead entails these economies of scale. And these are, for example, the capital surcharges for larger institutions. To which extent do you think this may have been or may be an obstacle to in particular to the larger banks to consolidate further?
Well, again, it depends on let's say the geographical level of consolidation we speak about. If we speak about consolidation at national level, generally speaking, there is no risk of becoming an enormous GSIB with a surcharge for a GSIB when there's a merger between two middle-sized banks. As you know, the GSIB surcharge is made for the 30 biggest groups in the world. So we have 8 groups in Europe, and that's it. So indeed, if one of these 8 groups wants to merge with a big bank in a big country, this could increase slightly the surcharge. But I don't really think that it's a real reason not to organize a consolidation within Europe in reality. This is not because there's a surcharge or 1% of solvency ratio. The key question is, what can I put in front of this potential surcharge, and can I generate more profitability through consolidation than the surcharge I have to pay? And this is exactly the reason why, for the moment, at a minimum, the number of operations is still at a low level. It's because generating profitability through consolidation in the current environment of low rates, etc., is not that simple. It's not because of a surcharge. And again, this surcharge could enter into force only for a limited number of the biggest groups in Europe. So I don't think it's a valid reason to not to consider that consolidation.
Yeah. Okay. Let me give now. I don't see Luigi on the screen anymore. So then, if we have lost him, I hope this is going to be temporary. But then let me give the floor to Andreas. We invert the order. Andreas, please.
Yes. Thank you very much, and especially thank you for inviting me to this webinar. I find these webinars very interesting, and I hope we have a big debate, an active debate afterwards. Now, normally you wouldn't expect any participants for such a webinar because a bank consolidation is considered to be an old hat, something which has been discussed as long as I can think about. But as Dominique, I think, rightly analyzed, it may be an old hat, but it's still quite relevant these days, and it's interesting to talk about. And I agree with all his findings. And if you sum them up, what really is at the core of the European banking system and the banking market is that the market needs to be more efficient, and that's why it's good that we do that. Now, M&A with regard to banks has a rather mixed track record, and I say that Elena is somebody who has been in the M&A market and who has been doing bank M&A all his life before I joined central banking. Why is there a mixed track record in terms of bank M&A? I would point to 4 aspects. First, quite often you don't see profitability rising the way you expected it. The stability of those combined banks may only in a few cases really have increased. Market power did not increase as predicted, and customer satisfaction, also not in all cases, was as predicted, which means that M&A is an important tool. And I agree with Dominique, who said that we hope to see more in order to make the markets more efficient. But by no means, and I don't think that Dominique meant that, but by no means M&A is a magic formula or is a magic bullet at all. Quality accounts, not quantity. And this is why I would like to put into the center of my little intervention 4 minimum conditions. I, as a former M&A banker and also as an observer from the central bank point of view, think are needed. So 4 minimum conditions which are needed for good M&A. And those 4 conditions, I believe, are the following. First, an M&A transaction, especially in European banking, is more likely to succeed if it is planned, I should say well planned, purposeful, and it may sound banal, but if it's done out of conviction, then out of compulsion. I have seen many banks which thought they need to merge because for many reasons, but if you do it out of conviction because you really do a complementary deal and you plan it well and you do it purposefully, you are much more likely to succeed. Second, also very banal, but M&A transactions have to be analytical. You can't do them out of a mood. You have to do a very detailed quantitative analysis upfront. And I have seen leaders of banks talking to merge with others on a very qualitative but not quantitative basis. I would recommend a very analytical stance to M&A. Third, I think that M&A transactions in banking need to be far-sighted. This is why you have to have as many scenario analysis as you can have, possibly, and you really have to take into consideration even scenarios very much in the future, which leads me to my fourth and my last point. The bank M&A transactions need to be creative. And this is especially true in a market ahead of the structural change we are going to see. So we are, in the past, where you look at this only quantitatively and you do draw a linear line, you really underestimate the dynamic of the banking market in Europe in the structural change we are seeing right now. Because this structural change very much will change the demand for financial services. Dominique rightly mentioned digitalization. So we are ahead of a rather radical overhaul. I, for myself, will admit that I have actually no very good idea what banking will look like in 2030 and which financial services actually will still be in demand at that point and by whom. So if you are ahead of such a radical overhaul, you need to be rather creative, and your scenario analysis rather has to sort of factor these changes in order to be successful. Maybe I'll stop here in time. Thank you.
Thank you a lot, Andrea. Let me just come back with one small issue. You and also Dominique mentioned the need for technologies, or at least how technology can help in improving efficiency. Now, one person in the Q&A box suggests, but for technologies and for using technologies to the best, we don't necessarily need scale. Because if we look at the fintech, for example, they are pretty small companies and they can actually be extremely efficient. So what would you respond to this?
I couldn't agree more. I think that in the old M&A practices, what you really try to do is you try to calculate economies of scale. You basically have two types of mergers. You have a merger with two banks with overlapping activities or with complementary activities. So these are basically the two variations you could possibly think about. And in the past, it was a cost-cutting exercise. We are living, as Dominique quite rightly described, in a world of European credit-based economies which were very sensitive to the interest rate environment and where you can't really do that much on the revenue side of things. So you're concentrating on the cost side of things and you're thinking about economies of scale and cost-cutting. Now, if technology is changing banking, and as I just said, I'm expecting it to change banking very much. These economies of scale play a lot smaller role and are of lot less importance and will a lot less be able to justify the merger than in the past. So that's what I meant with my short intervention, saying these are not linear lines, these are very dynamic situations. And this is why it's so important to have a quite radical scenario analysis on your expectations of future banking.
Okay, thanks a lot. Luigi, sorry if we changed the order, but we noticed that you had a connection problem. So I apologize, and please, the floor now is yours, and we are happy to have you back.
Mentioning technology, right? Well, I listened carefully to the two previous speakers. What I'm going to try to give is a perspective from someone who has been dealing with mergers and acquisition now for more than 30 years. And I actually remember I started my career dealing with the privatization of the first Italian privatizations in Italy. At the time, the Director General at the Treasury was a gentleman you might have all heard of by the name of Mario Draghi. And at the time, the Italian government embarked on the privatization of Crediop, which was a relatively small size financial institution. And I learned my first lesson in that context. I remember that we sat for weeks in the rooms at the Treasury, working out and preparing for the privatization. But the absolute most important message that we had received is that we were advisors to the government. We had to keep the whole process very confidential. Why was that? Because unlike with any other company in any other sector, the concept of a bank being sold is a very delicate thing. Is the kind of thing that can have people run for their deposits. And therefore is the kind of thing that when it happens and when the rumor starts, people start to ask themselves what is really going on with that bank. So when you're dealing with a bank merger, a bank acquisition, it's totally different from any other kind of merger. And I learned the lesson then, but it is an important lesson that I've sort of kept throughout my professional career. There has been very different times in the last 30 years. There's been times, as you will, some of you I'm sure will recall, when there was actually a rush to buy growth in emerging markets, for example. And so you could see in those days, many banks run for the assets in Eastern Europe, if we're talking about Europe, but it could be Latin America or it could be Asia. And you would see people paying 2-3 times book. And you would see that the bank that had paid 3 times book was, had its investors really applaud. And it probably was, followed by 2 or 3 other bidders that were very close. So in those days, in my job, what you wanted to do is to sell some of these banks and effectively create competition. And you always knew there were competitors for it. Then the world changed, financial crisis took place. And obviously, as you all know, in the last few years, bank mergers have only been either in 2008 forced by governments. Remember what happened in the US. The whole financial sector in the space of 2 months was drastically changed because at the time, a number of the financial institutions effectively risked to go bankrupt. The run of deposit I was mentioning before was exactly what's happening. Lehman Brothers is the example, but there were issues of liquidity effectively for almost every single financial institution. And so the government intervened. Think only of Citibank, where I currently work. Citibank was saved overnight by the government that injected $70 billion overnight. Otherwise, it would have been going bust. And in the space of 1.5 years, however, that same government recovered the 70 billion plus 20 billion that by that time had been the sort of new market cap of the bank. And today, Citibank is cruising in the $200 billion market capitalization. To give you a sense of how the world has really changed in the context of, again, these bank mergers and acquisitions. Where are we now? We are in a totally different world, where in the last few years, banks have been, especially in Europe, focusing on disposing of their non-performing loans and have been, to a certain extent, led by regulators to increase their capital ratios post-crisis. So we now have a European sector that is clearly much better capitalized than it has ever been before. And it is probably ready, and I agree with Dominique and Andreas, for a new phase of consolidation. However, this phase of consolidation, once again, will need to be conducted very carefully, because in the context of consolidation, again, when we're looking at banks, I completely agree with the fact that the asset quality and therefore a very analytical work needs to be done to be able to know what you're buying. In this context, it is interesting what we saw last year in terms of the Italian market as an example, where Intesa, as you know, bought UBI. This was a hostile transaction, very unusual in the context of banking mergers, because again, what you want to make sure is that you have the ability to look into the books of the target and that you spend all the time that is necessary really to understand exactly what is the quality of the assets. Now, this theme will be incredibly important after COVID for obvious reasons. It is very difficult to know exactly what the books are going to look like for banks post the current crisis. So once again, I completely agree, and obviously I have a vested interest that consolidation is important for banks. I think we're going to see domestic consolidation first, and then we're going to see European consolidation second, soon after that. Why is that? Very simple. In the year 2000, of the first 10 banks globally by market capitalizations, 4 were Europeans. Today, 20 years later, if you look at the first 20 banks globally by market capitalization, there is no European bank. This is, in my mind, for all Europeans, a real issue, as I think Dominique alluded to. For European corporates, the fact that they cannot count on any bank globally that can assist them in the way that Americans or Chinese these days can, in a world that is becoming geopolitically more complicated, it's certainly a competitive disadvantage that needs to be addressed. And I will stop here. Thanks.
Thanks a lot, Luigi. This was a very interesting excursus of how M&As and the consolidation in the banking sector has changed over the last, let's say, decade, and also what are the main challenges now. Now, you mentioned that in the past, when the banks wanted to expand towards emerging markets, they were paying a multiple of the price to book. So if I look at the price to book ratios today, they are incredibly low, in particular for the European banks. And let me say also for the larger ones, there are very few banks, even pre-COVID, that had a price to book above 1. So in your experience, in particular in your previous slide, to which extent is this really an obstacle to consolidation now? You mentioned we will see first domestic and then cross-border, and we will go there in a minute. But just starting from the low price to book ratio that we have, how difficult it is for a bank to actually merge right now with this potential dilution that the merger may entail?
Well, Elena, I think you're raising a very good question. You see, purely in financial terms, when you had to justify paying, a premium over book, let's not even talk about the 2, 2.5, 3 times that obviously we saw in many of these acquisitions. You have to really think through how you're going to amortize that goodwill, because clearly you're effectively financially, quote unquote, overpaying for that asset compared to what at least the books are telling you. And so there needs to be what at the time was called strategic merit. There needs to be a growth in that particular market. There needs to be a certain dominant position you're trying to acquire. There must be maybe some synergies with some assets that you already own in that space, and so on and so forth, so that you can find a way to justify those prices. I can tell you very often the real reason for those prices was the competitive syndrome. So you didn't want to have your largest competitor buy that asset. It was important for you as a CEO, for you as a bank, as a board, to continue to expand. And I think that clearly showed that several years later, not all these acquisitions were the right things to do. Now, the interesting thing is that financially, what you mentioned the fact that today most banks are trading below books, as you know, actually financially today creates an incentive, because badwill obviously has a lot of merit, creates capital. And so today, a lot of the transactions that we're going to see, we're actually going to see them driven not only, but also by these financial incentives. So my response to you is, if you are looking at a bank that is trading below book, and it depends where you're starting from. If you're trading at a premium to the target, it's already good news. If you're not, you're probably in need of looking at more a kind of merger as opposed to an acquisition, because it will be difficult for you, unless again the synergies are significant, to justify to your shareholders a premium paid for those assets. In any event, the key will be to be able to have enough time and spend all the time required to make sure that you understand very well what these books really entail in terms of the asset quality.
Okay, thanks a lot. So we touched already upon a lot of issues, but I have a few that I've written here that I would like to touch going forward. One is the domestic versus international dimension. Some of you have mentioned it, and I would like to touch upon, in particular, the obstacles for the international ones, and maybe starting with Dominique. But before we go here, actually, I would like to talk about another point, and this I would like to give the floor to Dominique back first to comment on the others if he wants to. But also, both Andreas and Luigi somehow highlighted 2 points that in my view are very important. The first one is that banks need to merge out of conviction, and there has to be value creation in some way. Where do you see the source of the value creation coming mostly from? Let me rephrase some of the things the other two speakers said. First of all, both said that in the past, mergers have not been very successful in terms of value creation, if I understood both of you correctly. So this should be changed, and we should try to change this going forward. Where does value creation come from? Andrea mentioned in the past it was more an overlaps of activities and maybe geographically even maybe. But now, where is the source of value coming from? Is more diversification of revenues? And therefore, we should expect a combination among different institutions, either geographically or product-wise? Or do you think it's again the overlaps of activities that may generate more value? Let's start with this question, and feel free also to comment on Andreas and Luigi.
Thank you. Thank you, Elena, for this fascinating question, if I may say so. There is no clear answer. We need to be open to the two models mentioned by Andreas, and by the way, they can be combined together. That's to say, some overlap on a part of a business model, and some complementary activities on another part of the business model. So what brings value? Again, it depends, and I think it depends on the situation where we are. And sorry to come back to this question of domestic versus cross-border, but if we start by the domestic markets, we start from a very different situation. In some countries, again, you have already a sort of oligopoly representing something like 70–80% of the banking assets in one country, made of 3, 4, 5, 6, not more, big groups. So here, the space for consolidation is completely different, and certainly not at national level, because these markets are mature enough not to give a lot of possibilities. On the contrary, in some countries, there is a much more fragmented landscape, based on also specificities, legal specificities, and I have in mind some, let's say, cooperative or mutual groups with very specific rules to respect, which do not give a lot of possibility of acquiring them, or for them to acquire somebody else. It's not that simple in some countries, but nevertheless, when there's a fragmentation like this, with no national champion, in that case, indeed, the growth inside the same country can provide for benefits which are immediate in case of a concentrating the means on what could bring more value. That means that depending on the situation at the national level, the answers can be different. On a cross-border basis, again, for banks which are sufficiently powerful and which are coming from countries with mature markets where there is no more space inside, that's a very natural trend to look outside and to see if they can continue to grow outside their national market. And here, this can justify to look at foreigners with a view to create more powerful groups. And again, by expanding a brand, a savoir-faire, some groups can deliver good answers. And I think that the traditions of banking in Europe can be really different from one country to the other. So it's never ever simple to merge or to acquire a foreign bank. And this is the reason why some mergers and acquisitions were not so successful. But we have also good examples, perhaps based on the previous crisis, but good examples of acquisitions, cross-border acquisitions, which were successful and which created a lot of value for the groups which realized them in the past. So this is not impossible. And I think that what is expected from shareholders, much more than from supervisors, again, they are considering the sustainability of a project, but for shareholders, for investors, indeed, the creation of value can come from new markets or more diversification of a business model. And I think this can be seen as positive.
Andreas, same question to you. You said that we need to be convinced of doing the merger. We, meaning banks, need to be convinced of doing the mergers. We need to be creative. Where does the value come from, in your view?
Let me talk about the environment in which you do a merger. And normally, the best environment is an environment where you have, for the foreseeable future, a solid economic activity. Yeah, if merging or buying bank assets into a declining economic activity is a lot less attractive than into a growing economic activity. So if we're talking about the European banking market here, what really counts is a stable banking union and a stable euro area. And not only for this year and next year, but for several years to come. And that is, in addition, this was mentioned already also by Luigi, in addition, you need transparency on the books and you need to have a good understanding of what you are buying and what the value of the book is. But I don't really believe in merging very complex activities, which banks have become very complex, especially given regulation, in a time when you are foreseeing economic decline. So, you have to have a good environment. You need some, how should I say, tailwind rather than headwind in order to do a value-creating economic activity. So the more stable we make this banking union, and the more stable the economies in the euro area are, the better the potential outcome of good mergers are likely to be.
Okay, but then let me come back to you with one following up question. I'm sorry to be maybe a bit provocative. I agree with you that we need a transparent and a stable environment. But if I look at the situation now, as Luigi was saying, this is not a situation of stability. I mean, maybe vaccination will improve. So is this the right time for merger?
I don't have to make that decision right now, but I wonder. Yeah, this is it's what the ECB is trying to do, and Dominique talked about that. They're trying to give regulatory certainty as much as they can on these 3 points which were mentioned. So you want the more certainty you have, the more bold you can be in terms of M&A activities. So regulatory certainty on bank consolidation and contraction, of course, helps. Nevertheless, we are not in a situation right now that we are in the most stable economic activity in the euro area. And this is why I think that while a contraction and consolidation makes a whole lot of sense, it's more likely to be domestic for the time being. And once we see a more stable banking union, I may add, a capital markets union developing much more, because we are lacking that in a big way. Even after Brexit, we are lacking it more, and a stable euro area economies, then the time I would feel better as a shareholder, as a supervisor, as a bank manager about merger activities. But that's a general point of view. That's not a specific point of view, but that's the way I would look at it.
Luigi, to you. You were the one advocating the importance of creating European champions. So what do you see in the value creation?
Elena, I think, well, first of all, I think it's important to understand each bank, in a sense, is different. And so a bank merger that is good for a certain bank is not necessarily good for any bank. The way I think of it, again, it's been a lessons learned over many, many years, is I think you need to look at the profile of your customers. What are you really trying to achieve? In the old days, a merger, no matter what was said, was essentially about cost synergies. And the more cost synergies, the more value. And the synergies were mainly branches that were cut, branches that were sold, people that were laid off. And that was the way in which you justify these mergers to the market, or the fact that you were moving into a new market because your clients asked you to move into that market. Now, it's obvious that for a bank that is mainly looking after corporates, you need to understand which are the clients and which markets do you want to follow these corporates into. If you are a bank that follows retail, it's a different ballgame. And clearly this ballgame today is changing once again, because the famous branches of 10 years or 20 years ago, today, I don't know of how many of the people on the phone today have been in a branch in the last 5 years. I think very few. So the strategic value of the famous branches of one day, today, it's actually potentially a write-off to come or a write-down, to say the least, okay? And so I think it's very important that you think through, as a CEO and as a board, where do you want to take that bank into the future? The reason why I advocate mergers, and I think mergers are positive for banks, is because I still think that in an environment where profitability is under severe stress, with interest rates where they are, mergers allow for scale and allow for synergies of cost. And this is one of the reasons why investors like mergers. I think that we as European, I completely agree with what Andreas was saying, and Dominique too, that there is a need for a lot of careful preparation for mergers. However, we don't have a lot of time as European banks. The world is moving very fast. Our companies, our corporates need these larger banks, need European banks to assist them around the world. And I think at the moment we're too insular, we're too, excuse me the expression, provincial in many ways. And so, again, I'm the European chairman of an American bank, and clearly I have a vested interest in looking at the world in a different way. But as a European, I cannot think that we can, spend a lot of time looking at our badly whilst the world moves at the speed that it is. I think we need larger banks, we need stronger banks, better capitalized to assist our clients, our corporates. Thank you.
Actually, let me touch on a point that is related to this. Let me now invert a bit the order and start with you, Luigi. There is Eli, a participant to today's seminar. He is an executive board member of an executive board member of a European GSIB, and now he is on a board of a large US bank. And his comment is that, in a way, European banks are too traditional, so there is too little innovation. And also in the discussion that we are having, we are mostly focusing again on mergers between banks. So how about instead considering other type of mergers, for example, including a fintech or including non-bank target or partners in some way? Would you think this would be a good way of proceeding? I understand what you said about you need to look at each bank, what the business model, what are the clients, but taking that as given somehow, what would you think about creating more innovation? And would you think, or better, would you think that the mergers can be a way to create more innovation into the banking sector when we talk about mergers among the non-banks?
Elena, if you take my statement at face value that you need to look at your clients, if your clients ask you for products that are digital products and you're not in a position today to provide them these products, but somebody maybe smarter or maybe created, unregulated, has been able to offer them these services, absolutely. I think you should be considering this kind of transaction. What is the issue? That what you will find is that you trade at 10, 15 times price earnings, and these assets sometimes don't have earnings and trade at multiples of revenues. So it's not going to be a simple matter for a board to recommend to make an acquisition, especially if for cash, at these kind of multiples. And so you will need to think through cleverly what is the best way for you as a bank to enter these spaces, which, by the way, are not regulated for the time being, and therefore can allow you, in some respects, also for that European consolidation or that global consolidation in that fintech space, which again, for many reasons, the regulated industries find it more difficult. So I am completely in agreement with the fact, and I can tell you, as an American bank, we are constantly looking at these kind of opportunities. We have in our DNA the fact that we think of, effectively finance as innovation. And innovation very often means that you need to look outside of your border. Again, starting from your clients, though. What are your clients really asking you? Thank you.
No, I think it is. I mean, many times we attribute the larger success of American banks also to alliances or operations with these non-banks or fintech type of companies.
But if I may, just to comment on that, not only American banks. I mean, again, just looking at our home market, but look at our home market. The largest value creation in financial services in Italy, to make a very simple story, has not been in the banking sector, has been a credit payment originally company by the name of Nexi. There is now basically worth more than many other financial institutions. And what did, in that case, an Italian bank, unfortunately not the one you're on the board of, do? They considered essentially buying a stake by contributing their asset into that business. And obviously that asset was paid at the multiples that the company was trading at. That's how they acquired their stake. They're sitting on that company. Now, clearly, you have to imagine Nexi serves all the banks in Italy, or many banks. So it's not going to be simple for, in that case, Intesa, to consider enlarging their stake without destroying value, because the other banks might not necessarily want to play any long with Nexi. But it shows you a way in which you can consider entering this space without effectively diluting yourself too much. Thank you.
Yes, Dominique, I was actually coming to you. Thank you for raising your hand, please.
Yeah, sorry to step in here, because perhaps we need to clarify one thing. I do not disagree with Luigi on what was said, obviously, but when we speak about consolidation, we speak about consolidating banks within the banking sector. To buy, to make an acquisition of a fintech outside of a banking sector is obviously very valuable, and it's absolutely necessary. I'm not entering into that debate, but I think when we speak about consolidation, we speak essentially about the question of overcapacity, about capacity of being better within the same banking sector. To go to acquisition to non-banks is a positive feature, but to my mind is something else. It's to be more ready for the future, to prepare for the new challenges mentioned by Andreas, but it's a bit different in my mind.
Dominique, if I may, Elena, I completely agree with what you said. I just want to give you a completely different example, but it shows the case. We have a very similar story today in many sectors that are at the moment where we're all considering ecological transition. Some sectors start to look a bit old, okay? So take oil and gas as an example. You have two options. If you are a large oil and gas company, you can merge with other oil and gas companies, stay in the same business, create synergies, and that is what many are considering and have considered. Or you can move into the equivalent of the fintech world and start to talk about clean energy and make new worlds appear. I think that obviously it's a completely different ballgame, but it's not dissimilar to what I think Dominique, Andreas, and I are saying. Consolidation is within your sector, but if you are a CEO and a board, today you need to look beyond your sector.
Andreas, what's your view on this?
Yeah, everybody is agreeing, so I'll try to disagree a little bit in order to get the discussion up. Contrary to Dominique and Luigi, I'm not so sure about this concept of European champions. Not because I'm not a good European, that's not the case, but I really must say that given the radical overhaul of the system, and the client needs and the client demand going forward, this may not be the right thing to do. It's not necessarily about the biggest size and the highest market capitalization in the future. It's probably about the biggest speed and the possibility and the preparedness to adapt to new situations. This is why we are seeing these very high fintech and shadow bank valuations, because not only they are unregulated, but they are also very specialized and very quick. And I am still afraid, given all the progress we made, though, I'm still afraid of a too big to fail situation. So I'm not so sure that the shareholders will actually really appreciate a very, very, very large new bank, which is ahead of a very complex merger implementation. I furthermore fear that the idea of a domestic European champion maybe has the risk of being politically misused. So while I see advantages of European champions and I see advantages of scale, given the change in customer demand, I wonder whether it is the right strategy and the best strategy to focus on size of assets, for example, or size of market capitalization short term, or whether or not one should think in different terms and different parameters. So just to throw this more controversial aspect into the room.
Dominique, what's your response to this?
Thank you. That's very nice to have a real debate. On the international side of the things, and the famous question, too big to fail. Perhaps you know that I was involved in these resolution questions a while ago, and I think too big to fail does not mean that we don't want to have big boys, big players. This is not true, by the way, when Luigi tells us that he works for Citi. Citi is an enormous monster worldwide. What we said at that time is we considered that it was impossible to let such a bank fail by itself at that time, because there was no solution at that time except from public money, and potentially the public purse was not even sufficiently big. So that's why we created some years ago collectively this new framework for resolution, starting from the idea that if you want to face your potential difficulties, you have to prepare for that, and you have potentially to pay for your future difficulties. And this is exactly the resolution framework. So again, it's not about finding a solution which would say we don't need big banks, or we want to avoid too big banks. We want to have big banks with good solutions in case of their own crisis. And this is the answer provided by the resolution framework. I don't say that the resolution framework is in place everywhere for all banks, that it's an easy task to build, but we are in this journey, and we've made a lot of progress. I can understand the risk raised by Andreas, but I think it's a bit more remote than before. Perhaps not in all cases, but a bit more remote. Let's accept that. On the other side of the things, that's to say on the domestic level, what about the need for a champion? I don't know if we need a champion per country. I don't think so in reality. What I say is that we need to answer this problem, this issue of profitability, lack of profitability, which can be partially explained by overcapacity. So when there is an overcapacity in a banking system, there is a competition which prevents the different parts of this banking system to be resilient enough to for instance, to cover the potential risks in NPLs, to take this example. By having less actors, more powerful, potentially there's a capacity to generate a better profitability to address this type of risks. And so to some extent, it's not about building one champion per country or one or two or whatever, but it's about building more resilient banking systems at national level, and potentially, and I still agree with Luigi, beyond the national borders at the European level. Thank you.
Dominique, thanks for this clarification. Let me come back to you. So there was a question asked in the registration, actually directed to you, that was asking to which extent actually resolution, given that you mentioned it, is an obstacle to deal with the overcapacity problem in banking. Do you see resolution as a tool that helps in dealing with this overcapacity, or actually an impediment for dealing with this? Or you see no connection?
No. I think there's somewhere in our mind, apparently, we have this entirely false idea that a consolidation is about, let's say, putting together lame ducks and creating marvelous swans. Sorry, but it's not about that. Consolidation is not about finding a solution for extremely weak banks. The good solution for weak banks is to exit the market in a way or the other. And from that perspective, to exit the market in an orderly fashion is exactly one of the answers provided by resolution, by this famous resolution framework. So I don't think that by essence consolidation is the answer to the weaknesses of some banks. It can be a solution in some cases when there's a real rationale for the shareholders of the better bank to swallow the weak one. But this is not the aim of the resolution framework. On the contrary, the resolution framework is to prepare for crisis, And by preparing for crisis, and I see what the question means, by preparing for crisis, in reality, we ask banks to be more resilient and to be better equipped and more capitalized with some instruments called TLAC, MREL, things like that. But this should not be an obstacle, because again, coming back to Luigi, what is in mind of the banks which want to merge, or the one which wants to acquire another one, is to create value and to answer its customer basis with good answers. And it's not about buying at the lowest price the lame duck, because it will be more costly for nothing. So to buy a resilient bank, to buy a resolvable bank, should not be seen as an obstacle. It should not be the driver of a decision. On the contrary, to buy a resilient bank means that, normally speaking, you don't discover by opening the door a bit too late, you don't discover that the bank is weaker than expected. And so from that perspective, I do not think that resolution is an obstacle to consolidation, not at all. It doesn't help, but it doesn't impinge on consolidation. There is only one thing I would like to finish with, is the question of resolvability of the group post-merger and acquisition. That's true that it's not enough to consider from a supervisory perspective the consequences of a consolidation. We need also to look at it from a resolvability perspective. And in some cases, if the group post-merger acquisition, call it whatever you want, is much more complex to resolve than before, there could be an obstacle here. But normally speaking, if the banks are already building their resolvability, to merge two resolvable banks does not create a non-resolvable new group.
Okay, thanks a lot. So let me we still have 7-8 minutes. So let me ask you a final question to all of you. Maybe we start with Andreas. We have been speaking so far about what makes good consolidation. So in particular, Andreas gave 4 criteria for what good consolidation is. Let's revert now the question. What makes bad consolidation, and not just the opposite of the 4 criteria? In other ways, if you are if we are now board members sitting on a board and there is a proposal, either because we are a target or because we are an acquirer or a merger of equal, what is it that a board member should really pay attention to before looking at whether it's value created, the merger creates value? But what are really the elements that a board member should say, okay, let's start with the checklist that is not risky, is not bad. What would make this list?
This to do in 7 or 8 minutes and distribute this over 3 people is quite a task.
Yeah,
but let me just start.
Just the main ones.
Yeah, very important is the cultural fit of the banks, depending on if it's a merger of equals, especially. Yeah, if you buy a very small bank, that may be less of an issue. But mergers normally are of similar size or reasonably similar size, and you have to have the right people, the right beliefs, the right culture. You have to have the right attitude of thinking about customer service and doing the right thing. If you find as a board member that these people you are dealing with are not trustful and you don't believe in the personalities of those people, in their approaches, I would be very careful. Let me start with one argument at least. So I think at the end, it's all to the people and the attitudes and their behaviors.
Luigi.
Again, given the time constraints, I would think the most important thing, if I were a board member, is to get a sense of what is going to happen to the market capitalization of my bank. Am I creating value? Am I destroying value? And I would want to make sure that I create value. Otherwise, I would not sign in favor of a merger or an acquisition. How do I create value? Cost synergies, revenue synergies. Clearly, in this context, badwill creation. And again, am I, at the end of the day, able to sell a better proposition to my clients or not? Thank you.
Okay. Dominique, from the supervisory side, what would you say, no, this is a bad merger, and you would sort of block it in a way?
Well, a bad merger or acquisition is the one which is not sustainable, in particular regarding the coming years. And from my perspective, and based on my own experience of some files, I think there are two, and I'm not at all in contradiction with Luigi and Andreas here, but just to give you two examples of things we should pay attention to, and which can explain failures in some mergers and acquisitions. The first one, sorry to come back to that one, is the IT systems. It was said previously that potentially IT is less necessary now because new technologies, etc. Well, for the moment, that's not true. When two banks, historical banks, want to merge, or when one wants to buy another one, not the first thing, but one of the key things to look at is the IT system and the capacity of building a common one if you want to merge, obviously, these IT systems. And the capacity of connecting those, if you don't merge them, is also extremely key for the success. Because if no capacity of merging and using the customer's data, there's a lot of there will be a lot of problems for your future customer bases and cross-selling and etc. etc. So IT system first, and obviously as a supervisor, my second remark would be on governance and internal control. When you look at the failures in the last years, they generally came from a lack of governance, a good governance, and I fully agree with the success, the features for success mentioned by Andreas. So governance and internal control, if they are not taken seriously, they can exactly be the reason why a merger fails. And that means that it should be taken immediately, extremely seriously. Building one system, again, connecting the two systems of internal controls, reshaping the three levels of control, whatever, but building something strong in terms of risk analysis and risk control, and then implying the governance bodies at the right level.
Thank you. I think this exhausts almost our time. I don't know if you have a final word that you would like to say, Andreas and Luigi. Andreas?
Don't take mergers lightly. They have huge upside potential and huge and considerable downside potential. So this is something where you really be very analytical and very, very thoughtful about. So it's not the magic bullet, but it's very well worth looking at it.
Richard?
Don't be afraid of mergers or acquisitions. Just make sure you spend all the time analyzing it. And the most important thing, pick the right time. There is always a good time and a bad time to do a transaction. Some of the transactions that have been the most successful one I've worked on, sometimes I've had to wait almost 10 years for the right time. So timing is of the essence.
10 years sound a bit long timing though, but okay.
10 years, it's not very long. Citibank is 200 years old. So 10 years for the right acquisition is the right, it can be the right time.
Dominique, last sentence for encouraging mergers?
Well, sustainable consolidation is good for Europe. I think that's exactly my key sentence for today.
Okay. I don't know how to thank the three of you. It was a fascinating discussion. I really thank you all. I think I personally learned a lot for your comments and remarks, and we make treasure of them when having potentially to be confronted with this situation. Thanks a lot, and I hope to welcome you again at the Florence School of Banking and Finance. Thank you.
Thank you very much.
And thanks
Bye-bye.
to the participants as well.
Bye.
Bye-bye.
Thank you.